Greetings from 3Edge Asset Management, and welcome to our monthly View from the Edge podcast for July 2020. My name is Fritz, and I'm the Chief Investment Strategist here at 3Edge.
And I'm Eric Biegeleisen, Director of Investment Research here at 3Edge.
As we do each month, Eric and I will discuss our firm's most recent outlook for the global capital markets, which is based upon our proprietary research model. And we'll point out any significant changes to our outlook which may have occurred over the course of the past month. So let's get started and let's talk about the markets. Tuesday of last week marked the end of the second quarter of 2020, and it was quite a quarter in terms of equity market performance. The S&P 500 index rose by nearly 20% in the quarter. Emerging market equities rose by over 17%, and German equities rose by over 25%. Meanwhile, the COVID-19 pandemic is seeing a resurgence in the US, particularly in the Sun Belt, where states such as Florida, Texas, and Arizona were early to reopen their economies. However, investors, at least thus far, have continued to look beyond the pandemic, and so it remains to be seen what effect a material rolling back of the reopening of businesses in some of these larger states may have on the markets from here. Meanwhile, the Fed continues to supply ample liquidity to the financial system and the markets, and both the June unemployment and non-farm payrolls reports were better than expected. And lastly, it seems like Congress will eventually pass an additional stimulus bill. So with all that going on, glad to have Eric Biegeleisen here with me today, Director of Investment Research at 3Edge, to sort all of this out. So Eric, let's discuss the 8 major asset classes that represent the highest level view of our investment universe. And in particular, let's discuss what changes may have occurred in our model research since early June. And why don't we begin with the equity markets, which I said earlier have obviously had a very strong second quarter coming out of the steep correction in February and March.
Yeah, thanks, Fritz. With the truly unprecedented monetary stimulus from the Federal Reserve's programs of supporting bond, corporate credit markets, alongside the unprecedented fiscal stimulus from the trillions of dollars of stimulus in the CARES Act, PPP programs, and the like, we've seen a V-shaped recovery in the markets. The economy, though, is a different thing. We'll start to see Q2 earnings in the coming weeks, and it'll be interesting to see what the earnings are, what the forward guidance looks like, that is, if many even provide it, and how the market digests it all. Currently, though, it seems investors believe there is an implicit put option by the Fed and Congress to save the day in the short to medium term to bridge the markets until we live in a post-COVID world. And to some degree, prices may be already reflecting that.
Very good. So why don't we take each of the 4 major equity asset classes one at a time, and we could begin with the U.S. equity markets.
Sure. Yeah. So case in point is the U.S. While we still view U.S. equities as being overvalued and getting more overvalued, the support from monetary and fiscal stimulus looks to keep this momentum moving upward. Though perhaps with some volatility ahead based upon earnings season, like we discussed, as well as possibly, as we've seen, the news headline of the day regarding anything from elections to vaccines, you name it. Also, though, worth mentioning is that risks do remain for U.S. equities beyond the levels of overvaluation. You have a very significant level of concentration in the U.S. equity markets now by just a small handful of mega tech companies.
Great. So let's jump to emerging markets, which also enjoyed a strong second quarter of investment performance. And what is our research showing us in terms of EM equities currently?
Sure, yeah. The model research is seeing much more confidence in emerging market equities due to a valuation level that is fair, positive investor momentum. And as we mentioned before, the accommodative U.S. Federal Reserve monetary stimulus, which helped to somewhat relieve EM companies and governments' U.S. dollar-based debt burdens. Mm-hmm. On a valuation basis, it's more attractive than other markets, particularly the U.S. And we've seen a steepening in the yield curve measures in the emerging markets, which is indicative of the potential for future growth in these economies.
Great. And let's shift over to Europe in particular. Let's look at German equities, which actually outperformed both the US and the emerging markets, gaining approximately 25% last quarter. What's our research model telling us about German equities at the moment?
Yeah, like EM, emerging markets, we've seen a steepening in our yield curve measure for Germany, which is a positive. And German equities have and may continue to benefit from their own stimulus measures. So certainly much more positive than we have viewed in recent months.
Very good. And lastly, Japanese equities. What's the situation there in Japan?
Yeah, so Japanese equities have been quite undervalued by our measure for some time. We've discussed that many months. And though more recently, the model has signaled a more positive outlook here, which we discussed last month, due in particular to the steepening yield curve measure that we saw there. And so this points to improved growth prospects. And Japanese companies as well are also more experienced than many others in operating in low growth environment with more resilient balance sheets and more stable dividends. So bit of a positive outlook here as well, more so than we've seen in recent months. Yeah.
Very good. All right, so let's switch gears now and go from stocks to bonds. And what is our model research currently indicating in terms of the fixed income markets, both rates and credit?
Yeah, the model's preference in fixed income is more focused on shorter term US Treasuries, as the risks to intermediate term Treasuries from interest rates rising just outweighs the benefits of the yield they offer. In terms of credit, we see this area continuing to benefit from the extraordinary Fed intervention in the credit markets, though we still see risks here due to the increased levels of debt now outstanding for everyone. You know, everyone's balance sheet is being encumbered with these increasing debt burdens.
Right. I thought it was interesting. I heard Steve make a comment today actually about how his opinion was that the Fed has now extracted all of the future returns that one could try to earn in the U.S. Treasury market. I thought that was an interesting comment.
That is interesting.
Let's take a look at real assets now, and that would include both gold and commodities, starting with gold. And gold, as I think I mentioned earlier, is up approximately 17% year to date in 2020. What's the model saying in terms of gold?
Yeah, the gold's been pretty steady outlook for the model for quite some time now. It's been fairly bullish on it for a long period of time. As the Fed drives interest rates further below the rate of inflation through its Treasury purchases and rate guidance, real rates have fallen further into negative territory, which just has continued to be supportive for a favorable outlook on gold.
And what about the other part of the real asset class, and that would be commodities? What are we seeing there?
Yeah, so while the outlook for commodities remains mixed still, they are deeply undervalued by our measure, along with some early signs. And we mentioned this last month. We've been looking for that catalyst for reinvestment, given just how undervalued the commodities have been. And we believe that we might be on the precipice of seeing that catalyst present itself, but we need a little bit more confirmation, and we may get that this month. So we've been eagerly watching this model.
And interestingly, maybe just a little bit more detail in terms of emerging market momentum in commodities. How does that play out? Because that's pretty interesting.
Yeah, so there are a number of signals in the commodity model. We look at credit spreads, including investment grade high yield, TED spreads. We're looking at compression of those to be indicative of investment opportunities for companies, which might manifest its way into growth prospects for commodities. But particularly when you look at emerging market equities and you look at the demand for commodities, there's a strong connection between the two. And so when we see a strong rise in emerging market equity prices, that typically leads to a follow-on effect of a rise in commodity prices as well. And so as we have seen EM equities rise, we expect commodities potentially to do well, but we need a little bit more confirmation of that before we're ready to jump in.
Very good. Now, I thought that was very interesting. So lastly, short-term fixed income cash equivalents, which we affectionately refer to as dry powder. What are we seeing there?
Yeah, as we've said before, short-term fixed income and cash continue to serve as that dry powder to reinvest in assets at potentially lower prices in the future. While we put some more of that to work recently in client portfolios, some dry powder still remains. So we'll certainly be on the lookout for future investment opportunities, whether that be in equities or in commodities or wherever it may be, wherever the model points us to.
Very good. All right, Eric, thank you for getting us caught up in terms of our outlook for the global capital markets. And now, as we do each month, I'll ask Eric for his 3 most important takeaways from today's video podcast. So, Eric, what do you have for us this month?
Sure. Number 1, there was a significant equity rebound in Q2, and it seems this may continue for some time, though perhaps with a bit more volatility. Number 2, more specifically, emerging market equities may be the biggest beneficiary of the U.S. Federal Reserve stimulus measures shorter term. And 3, the deeply negative real rates alongside unprecedented fiscal and monetary stimulus continues to be supportive for gold and may soon too include commodities.
Excellent. Very good. Thank you very much for your insights. That will do it for Eric and me here at 3 Edge Asset Management. We will be back once again in early August. I can't believe it's already going to be August, with another View from the Edge video podcast. As a reminder, our podcasts are always available on iTunes and at our website, 3edgeam.com. In addition, all of our videos are always available on our YouTube channel. Please feel free to share any of our videos if you think that someone you know might be interested in listening to them. And so that's a wrap. From everyone here at 3 Edge, stay safe, stay strong, and keep the faith. Thanks for listening. And Eric, thanks again for your insight.
My pleasure. Thank you.